All right, welcome back. My guest on the show today is Surendra Goyal of Citi Bank. And the questions which I want to really post at him are very simple. Why have markets managed to climb the wall of worry? Are markets telling or indicating that the worst of the newsprint is behind us? Did market fall in the month of March and April because of excess pessimism? And how should India now get viewed from a global context, given that we've got good news on the medical front and also on the oil front, the macro news is looking exciting. Surendra, fantastic to have you back, and thank you for joining us. We all know the bad news, Surendra, whether it's on the medical front, on the economy front, the fact that central banks are printing money and crude has collapsed. There are a lot of factors which have come together. Now, the world has never seen a combination of a sharp decline in crude, excess liquidity, a medical crisis together ever. So if world has never seen these factors together, how can one understand, predict, or make a calculation of what is coming next?
Sure. Thanks, Nikunj. Thanks for having me on the show again. Okay, so to answer that question, Nikunj, let me just kind of step back a little how we were thinking 1 month back and what we are thinking about the market now. And as you rightly said, this is a very unprecedented kind of situation, kind of event. And because of that, there are a lot of unknowns. And in this kind of a situation, forecasting obviously becomes that much more difficult. Now, if I step back a month back when we put out a report where we set a 1 year or a March next year Nifty target of 10,000. Okay, at that point of time, the Nifty was sub 8,000, and obviously it was falling every day. So there was a lot of pessimism. But when we kind of went back to the basics, which is the indicators that we look at, and these are like fairly simple things like bond yields and earnings yields, the differential between that. We have a sentiment indicator which kind of bakes in a lot of variables, 11 variables, and it comes out with a reading on how much pessimism is there. And when we looked at all of that, it was looking quite attractive from a historical perspective. And then we said that obviously right now there is a lot of pessimism. Things are looking very, very difficult. There are a lot of unknowns. But as we go forward by, say, September, October, FY21 will obviously be a very tough year on earnings. But FY22 on a low base, if it looks like a normal year where GDP can go back to, say, 5.5%, 6%, then at that point of time, the market will be looking at FY22 because FY21, obviously, people will realize is going to be a super difficult year. And on those earnings, okay, so you take FY21 earnings to be very weak and FY22 earnings to be high on a low base. And on that, if you take a 17-18 multiple, which the market has been trading at over the last 4-5 years since domestic flows have been strong, that kind of gives you a Nifty target of 10,000. So that is how we arrived at that target at that point of time. Now, what has happened in between in the last month or so is that the market has rallied 25% in a straight line. Okay, and obviously it perplexes a lot of people, but my view on that is a lot of negativity got priced in when we saw the big fall of, say, 25-30%. And then what happened is, as you have seen in this earnings season, as the results come out, if they are not very bad, actually the stocks are going up. So in my view, a lot of negativity got priced in, and then that is what kind of helps stocks do better. But having said that, 25% returns in a straight line in this kind of a scenario is a lot. So for now, we are maintaining our March Nifty target of 10,000. And we would be recommending people to buy the dips because clearly the market has done very well from the lows over a very short period of time.
Okay. Now, in the short term, Surendra, market are a function of technicals, flows, macro, positioning, and also fear. So in the short term, we don't know where the markets are headed. So let's talk about medium term. In your assessment, do you think markets are still slightly optimistic on FY21 and FY22 earnings? Because most of the corporates, Surendra, we've spoken to, we had Axis Bank in the morning, we had Infosys last week. All of them are saying that, look, we don't know what's coming next because we frankly are not in a position to give you guidance. So in that kind of a scenario, how does one go about understanding and penciling and calculating EPS growth or EPS compression for this year and next year?
Okay. So I think I'll say two things here. Firstly, in terms of how people are thinking and how people are positioned. We did a survey of investors, the buy side, and 100 plus buy side folks participated in that survey. And interestingly, more than 65% of them thought that the market is going to test, or Nifty is going to test 7,500 again. So clearly from a sentiment perspective, and this was done maybe 10, 12 or 2 weeks back or so. So sentiment perspective, things were bearish. And when I talk to people, I still feel that sentiment is reasonably bearish, I would say, right? No, as you rightly said, that these are super difficult times in terms of forecasting earnings, and that is true for companies also. So what we look at is we look at past instances of similar kind of situations. Now, each of these one-off situations is very different, right? But we have to have some kind of a framework. So what we did is we put out a note even as recently as last week, where we looked at nominal GDP growth. Okay, and if you see years in which nominal GDP growth has been lower than 5%, in those years, the top line growth for the listed companies has been flat to negative. Okay, so that is some kind of a framework to use in this kind of a situation, because obviously companies will also not be able to tell us. Okay, for IT companies, for example, one could kind of draw parallels from the global financial crisis. And you could see that at that point of time, how the world reacted. Now, this situation will be a little different. But in the absence of any other framework, that's a relatively decent framework to work with. So that's what we are doing now. From an earnings perspective, to answer your question, a month back or month and a half back, whenever we did that note, what we did is historically or in the past, we have always taken our team's bottom-up earnings forecast for the Nifty. And that is what we have used to set our targets for Nifty. But at that point, it was very clear that this was, again, a very unprecedented kind of situation. And the bottom-up estimates may get revised with a bit of a lag. Okay. So bottom-up estimate at that point of time was in the teens, 15, 16% earnings growth. When we set the target, we took that earnings growth, we put a top-down expectation, which is our expectation, and we said that earnings growth will be 0 to marginally negative. Okay, and we put out this note last week where we looked at nominal GDP in this kind of situations. And we actually now saying that growth could be, say, -5, -10% for Nifty. And again, this is all looking at historical examples of how things have panned out in periods of low GDP growth rate. So I would still think that that's a better framework to work, because obviously it's an uncertain world, and even to that extent, companies will find it very difficult to guide. And then obviously, once you are factoring in a very low growth or a decline in FY21, you have to keep that in mind, that if the world normalizes, which is the base case we are working with, and next year India gets back to a 6% plus GDP growth, then can you get a very strong earnings growth on a super low base? So that to me is very likely. So that is how we have gone about looking at it. So bottom-up earnings estimates for our team, as well as consensus, even today when we are speaking, they are in high single digits growth, right? While what I am telling you, what I am penciling in is a 5 to 10% decline. So I think one has to take a top-down view. One has to look at similar situations in the past, and using that kind of a framework, possibly one can arrive at some kind of reasonable estimates, because the bottom-up earnings estimates will get revised with a lag as analysts hear company commentaries, and then over a period they react to those numbers.
Do you worry about financials now? And there are a variety of factors. Some of the factors are very well known, that there is a cash flow crunch, there is over ownership by FIs, and there is a clear fear in the system because banks are not lending, and we know the debacle which has happened in the debt market. Do you worry about where financials are headed?
Yeah. So if you see my last couple of notes on earnings, they have specifically mentioned a point that in terms of incremental earnings risk to the market, financials is a sector which one should be watching out for. Because the challenge today is that we are working with an unprecedented situation, an unknown trajectory of the virus, and because of that, the economy. And given that, it is very difficult for any analyst to forecast what the credit costs are going to look like. And to that extent, the risk on financials earnings are going to be very high. Now, having said that, now the view on stocks could be a little different, because in this kind of a situation, what we always see in any sector is that the stronger companies, the larger companies tend to come out stronger. And if the market is not discriminating and every financial is being painted with the same brush, it could throw up some interesting opportunities. But that's a separate point. On your point on earnings, absolutely, we have been highlighting that part of or that sector from an earnings perspective, there are risks, and which is where we one of the reasons why we went to -5 to -10% growth on Nifty earnings was to price in some of the risks around financials.
In this kind of a scenario, even though you've got the most conservative target, I can argue back and say that just 10%. Why do you think the cut will be 10%? Why do you think it cannot be more than 10% or even 20-25%? I'm just trying to understand that why have you arrived at a number of 10%?
Yeah. So I kind of alluded to my framework, Nikunj. So if you go back and see the only equivalent kind of situation, I won't say similar situation, as I said, all these situations are very different and unprecedented, was global financial crisis, when you saw this kind of earnings decline, right? And even today, when you kind of look at some of the stronger balance sheets, okay, you see that some of those companies may be able to come out of this relatively less impacted. Similarly, in sectors which are exporters, you could actually have benefit of the depreciating rupee, which helps both your revenues and margins. And to that extent, those companies could be relatively less impacted. You could have certain companies which will benefit a lot from the lower oil price. So those companies may have their earnings less impacted. So obviously, you will have to look at all of this. And right now, I fully understand when sentiment is very bearish, that is the kind of risk. But I think I would just mention one point, that you have to work with some kind of a base case. What we were working with and what we are working with is that the first quarter is going to be very tough on GDP growth and earnings. And then gradually things start normalizing. And January, February, March of next year will be a close to normal quarter. Now, if those assumptions get pushed out, obviously you could have things which are worse than my numbers. But our belief is that with those kind of assumptions, the numbers that we are talking of are quite realistic. The second point you need to keep in mind is we are talking of the Nifty. And Nifty is generally the stronger companies when you compare it to the rest of the listed space. And some of these companies will definitely take market share because they have the balance sheets to tide over the slowdown and gain market share. So when you put all these factors together, to us, a 5-10% decline in earnings looks like a reasonable estimate at this point of time.
Now, whatever we are discussing is subject to how soon the lockdown will lift. As we speak today, there is no official information from the government. So in your model forecasting, where you're talking about a 10% decline in Nifty earnings, have you done some work on lockdown, how it has impacted the economy? And if the lockdown is extended more, let's say for 2 weeks or another 3 weeks of partial lockdown comes into play, how would you model that then?
Yeah, so it's very difficult to model it week by week. Right. So what we did is, like, purely from a GDP forecast perspective, our economist obviously has a negative growth for the first quarter, and then a gradual improvement, and then a decent January, February, March quarter. And similarly for earnings, that is what we have asked our analysts to pencil in when they are forecasting bottom up. And from a top-down perspective, we are focusing more on annual numbers. We are not really trying to break it down very granular into quarterly. Okay, so based on all of that, as I said, if first quarter very difficult, gradually things normalizing, and January, February, March, okay quarter, that is how we have arrived at the numbers. If any of those assumptions change, for example, the lockdown continues into second quarter or anything of that sort happens, then obviously there could be a further risk to numbers.
Okay. When you talk to some of your counterparts, when you talk to some of your clients, especially in the light of that in India the medical news is better, oil price drop is great news. Do you think India becomes a special situation stock where it will fall less and it will gain more? Because if I look at currencies also, Surendra, Indian currency has fallen perhaps the least in the emerging currency basket.
Yeah. Okay. So see, currency and markets, I would maybe differentiate a bit, because on the currency side, obviously, oil is a very big variable, right? But from a market perspective, when I talk to our clients, uh, obviously, in the month of March, there was a lot of fear, because at that time the COVID situation was just about getting starting in India, and looking at the population density, etc. Clients were very worried about the kind of numbers that India would see and the kind of damage it could do to the Indian economy. Now, as things have played out, things look a little better than what was feared for sure. Okay, and I think clients are still in wait and watch mode. If you look at two things, which I think partially would answer that question. One is, if you look at March FII outflows, obviously very big outflows in March. April also has seen outflows, though a much more moderate kind of a number. So at this point, I wouldn't say that we have seen FIIs really buying in. India has still underperformed, at least in the EM context. And the historical premium which India has traded to EM, MSCI India has traded to MSCI EM, is around closer to 40%. Right now, we are at closer to 30%. So that also does not suggest that India is really a trade which a lot of FI investors are playing in. Having said that, I think another month, if the data on the health side continues to be favorable, and given that oil is where it is, it could be an interesting time for the Indian market, but I would still kind of wait out for the data coming out over the next 2-3 weeks.
Let's take a deep dive into sectors. HUL is at an all-time high. Britannia almost at a 52-week high. Other consumer staples have also not corrected the way rest of the market has corrected. Do you think this kind of an outperformance in consumer staples is here to stay?
So again, my view would be that if you look at my base case, which I already spoke about, right, that things gradually normalize from second quarter onwards. Right. And today, the premium which the market is paying to staples is for near-term visibility and possibly less damage to earnings. Okay. And if you see, all the defensives are doing well, and staples has possibly been one of the better performing sectors. But as we go forward, I still think that as other sectors come out and gradually start improving, there is a case for underperformance on the staples side. And if you look at my model portfolio, staples is actually the biggest underweight from here on, where we think that a lot has gotten priced in. And these are steady stories, but obviously at this kind of multiples, the other sectors have a better outlook in terms of risk reward going forward. And some of the other sectors will end up doing better than what consumer staples does as we move forward.
Okay. The street is divided on how to look at IT. One side, there was fear of a supply and a demand disruption, but IT companies are telling us, look, we've started working from home. TCS has been legendary in indicating what they've done to work at home employees. What is your view? Do you think this is as bad as 2008 for IT companies, or IT companies are in a better place?
Yeah, Nikun. So to answer that question, in the past, whenever I would have come to your show, I'm sure IT would have been one of my bigger underweights in the model portfolio. Okay, today we actually have a small overweight on IT, and IT companies in general have good balance sheets. Now again, there may be exceptions, but I'm saying for most of the large companies, they have good balance sheets, good cash flow generation, and in this kind of markets, you want to be in companies where cash flow is decent, balance sheet is decent. Okay, and the depreciating rupee does provide some kind of offset against the pressure that they will see in terms of pricing, in terms of clients deferring projects, all of that. So while the business is still challenging, I wouldn't say that the business will not be impacted. We are building in, say, a mid-single digit kind of revenue decline for some of the larger IT companies in FY21. But as I said, with strong balance sheets, they will tide over the crisis, the situation quite well. And in my view, come out very strong. And that is the reason we gradually have been increasing our weight. And in the last note, we went small overweight on the IT sector. Granted, visibility is low, okay, but these are very defensive businesses. A lot of the business is keeping the lights on for customers, and that kind of business anyway doesn't get much impacted in this kind of a situation. So visibility is low. What we are expecting is you have a couple of tough quarters, and then gradually you will see a recovery. And there are certain areas like cloud, collaboration, etc., which will see a lot of spending as we go forward, right, with more people working from home, etc. And on the initial disruption bit, talking to companies, a lot of people are now working from home. So barring very specific kind of BPO work, we think that that part of the disruption is now in the numbers. Okay, so from here on, I would be more worried about demand and demand getting impacted rather than the supply side disruption.
What is your view on some of the deep value stocks, PSUs, metal companies? Not every metal company has a balance sheet problem. Some PSU companies are flooded with cash and they give a lot of dividend. When the market reboot happens, Surendra, the market leadership, it tends to change. Do you think the market leadership could migrate back to deep value, high dividend yield stocks?
Yeah, Nikun. So I think I would answer that question in maybe two parts. One is I think one has to consider the time frame and the risk appetite and what kind of a drawdown are you willing to take to answer that question. So if I look at 1 year and 2 year performance post the global financial crisis, some of the names of some of the sectors which you said were the best performing sectors then, right? So it can still happen. But at this point of time, we are being selective about PSUs, selective about metals. And we are kind of going by the strength of the balance sheet. We want to be in companies which are stronger and not really, we don't have a big overweight on commodities. We actually have underweight on commodities with a selective overweight on a couple of metals companies. So at this point of time, we are selective because, as I said, the market has rallied 25% in a straight line. And the outlook is not going to be things improving in a straight line. So one needs to be careful about balance sheets. So that's how we are positioned in the sectors at this point of time.
Okay, closing comments. We've extended our time with you. It's almost 25 minutes. Where do you think this entire crisis will create a large opportunity? Which end of the economy or which end of the market do you think will emerge as a disproportionate gainer? Because trends and digital activity will force you to do adaptability and make those changes.
Yeah, so I think few areas which will clearly gain. Okay, now I think when you are looking at businesses, you have to keep in mind that certain areas of the same business may lose out and certain areas may gain. Okay, so I think digital transformation, for example, on the technology side, okay, be it things on IT infrastructure on cloud, the cloud migration kind of work will really pick up. Collaboration, right? When people work from home, they end up using collaborative tools a lot more. So that is clearly going to change. You may see a lot of change on the media side with OTT really becoming more significant because people get habituated to it in the downturn. Okay, similarly, what happens post the lockdown is also equally important. Will people want to commute using personal vehicles? That could have some kind of impact for the auto industry, right? On the banking and financial side, payments, etc. And again, the whole digital mode of doing things. All of that, those companies could be big beneficiaries. So I think what we are seeing is a change across all industries in some manner. E-commerce is the other one, which I did not talk about. You are seeing people getting everything delivered. So that is again another industry which one needs to watch out for. So there will be a lot of behavior changes, but I think it will also depend on how long the lockdown situation lasts. because the longer it lasts, I think people get habituated, and then that in some ways becomes the norm of doing things.